How's everybody doing?
Good.
Good. Ladies, you guys look so slow. So first of all, I always do this. Thank you so much for being here. I know some people have exams.
You're welcome.
Thank you, because I really appreciate it when you're presenting and your friends comes and see our presentation. It really makes us really proud. So I would like to begin our presentation today with this picture. This really cool picture. It was taken in 1960s in the New York Stock Exchange. So guys, let me ask you this question. What do you see in this picture? Anything, just shout it. What do you see in this picture? Can you guys see the pictures from behind?
Envelopes. Slurry people.
What else?
A guy holding a
Stockbrokers, all right?
A series of compartments.
Old people.
What else?
Paper on the ground.
Okay, I heard a lot of things. So, what don't you see in this picture?
Electronics.
Computer.
Yeah, that's right. Those two guys mentioned it. Computer electronics. That's right. Because in 1960s, stock market still used less computerized system. But in 1980s, computer and software was introduced to the stock market. And the software was able to do automated algorithmic trading. So basically, you can do sell or buy stocks with computer. That is what automated algorithmic trading do. But that was 1980s. Today is 2015. What do we have in 2015? In 2015, we have the thing called high-frequency trading. What is high-frequency trading? High-frequency trading basically an advanced software of automatic algorithmic trading. So, what's the difference? HFT, or high-frequency trading, can purchase a huge share, hundreds or even millions of shares in one press of button. Not only that, the time, so fast, even the people in stock market who uses HFT call it nanoseconds, because it's this fraction of seconds. It's 0.000 something second, super fast. So as you can see here, we will discuss more about the high frequency trading. Here, I have my lovely associates. Say hi guys. So first, Karina Ju, she will explain about how HFT works and the problem with it. And then next is market manipulations. Will Pan will take care of that because they're too fast. They're making market manipulation, and he will go in depth that. And the last part will Prince Wang is right there. He will tell you more about flash crash. What is it, and how HFT contributed to flash crash, and he will slightly tell you the solution for this from the expert of HFT in New York Stock Exchange. So Karina, please.
Thank you, Christy, for the introduction. So how does high frequency trading work? To better understand this, I think that it'd be best if we use some specific numbers. So say that there's 10,000 shares that I want to buy, and in order to buy those shares, I would send those orders to the data center, and this is where the concept of colocation comes in. So what is colocation? Well, colocation basically means that all 12 U.S. stock exchanges are located in 4 buildings in New Jersey. And in these 4 buildings, they host a bunch of black boxes. And these black boxes are machines. Like Risky mentioned, they're powerful computers with algorithms that will process a very large volume of information in a very short period of time. So before we proceed, in these slides you'll see red lines and blue lines. And red lines represent high frequency traders, and blue lines would be me. So after sending these orders, for example, we say that maybe 5,000 of these shares reach the first venue. So as soon as these 5,000 of the shares reach the first venue, all the other stock exchanges that are closer to the first venue will be notified of my orders. they would know that maybe I am motivated to buy even more orders of shares. So they would front run me. They would get to these revenues before I can. And the time difference between them reaching all these different venues would be as little as 1/4 of the amount of time that would take my orders to get to all these different venues. So by the time that my orders finally arrive at all these different venues, all those orders are already gone. So this is how frequency trading works in a very simplified version. So does anyone have any questions? Yes.
Right. So they beat you to the shares and make it more expensive for you, or do they like capture money there, or they just beat you to it?
They beat me to it, and they could sell them for a higher price.
That is actually what we're heading after this slide.
Okay, sorry.
So you got a point.
Any other questions?
Any other questions? No?
Does it mean that you have 5,000 shares now, or do you have 10,000 shares now?
So I want to get 10,000 of shares, but then only 5,000 of shares reach the first venue. Of course, it could be like 1,000, 2,000 of those shares. But basically what I'm trying to do that is only a portion of those, that huge order, got to the first venue. But all the other ones are going to take a little bit more time to get to all these different venues, because not all shares are going to get to one venue at one time, because it is a very large order. So before we proceed, do you guys think that, what would be a problem of high frequency trading? Well, he kind of mentioned that. About you.
Joe?
All right, I'll go ahead. So the problem that I could identify right away is not everybody has access to the kind of technology that would allow them to use high frequency trading.
Yeah.
That's one of those.
That's one of them. Yes. Okay. So these high frequency traders, they reached all those venues before I did. So they have all these orders in their hands now, and they benefited from purchasing these orders before me because they can sell them back to me for a higher price per share. Well, this is only a very small fraction per share, and it's not that much if you're thinking it's just one share. But most of the times, high frequency trading, they mostly impact short-term debt traders and professional traders. So among the large institutional investors. So at the end of the day, they will add up to a very large chunk of money. And actually, in the history of high frequency trading, one Wall Street Journal article mentioned that the high frequency traders have made as much as $60 million in one day in the U.S. stock exchange alone. And now we'll turn our attention to Will to learn more about the underlying problems of high frequency trading.
Hello, everyone.
Hello.
Hope you had a nice day. So, I believe it's 2010. 2010, HFTs made up roughly 10% of daily trading in the United States. Currently, by some estimates, they account for 60 to 70% of daily trades. Couple that with the fact that traders are becoming, due to technology, becoming linked in unprecedented ways, and cheaters of the market are becoming increasingly sophisticated, which is causing a lot of problems for regulators. What's more, futures trading has essentially become computer trading against computer. So, there is a bigger threat from market manipulation than there ever has been in the past. Today I'm going to talk about two different types of market manipulations, and I'm going to talk about a real-life example of one. So that's the first one. First one's called spoofing. And it's when an HFT, high-frequency trader, uses their resources, their technology, namely their speed, to change other market participants' perception of demand for buying and selling in the market. As you can imagine, how you perceive the demand of buying or selling of a share would greatly influence and impact your behavior in the market. So, for example here, Spoofer, and I also touching on Joe's point a little bit about resources, that yeah, not everybody has access to this high, fast-paced technology, and it kind of seems logical that the ones who would have access to this technology are also the ones who have the ability to purchase, to make large share purchases at one time, which would have ripple effect in the market. So the Spoofer offers to sends an offer out in the market for 100,000 shares below market price. What are the other market participants going to do? They're going to recognize that trend, and the honest ones who are going to naturally be behind the HFTs. So they're going to see this trend and they're going to sell. Well, the Spoofer, being the crafty, clever, devious character that he is, he or she, picks up on this trend long before anybody else could even fathom, and cancels the order. And then they go and they clean up on all the short sells, and make lots of profit. And again, touching on Karina's point that HFTs do not make profit off of profit margins. They make profit off of sheer volume. In fact, the individual gain is minuscule, but they're able to pump out the sheer volume they're able to pump out in minutes of trades leads to their high profits. So, next I'm going to talk a little bit about a real-life example of spoofing. So there's a court case, federal case in Chicago involving a company called CTG Capital. HTG Capital. I'm sorry, I forgot that. HTG Capital, and they are trying to use legal coercion to get the Chicago Board of Trade to identify people on their order sheet. And because they are accusing people on that order sheet of spoofing. So Bloomberg did an article on it, and I think they have a nice little simulation that shows just like how fast this trading is. Okay. Just really shows how fast these machines really are. And this is what 60 seconds of trading in one market would look like. Holy So as you can imagine, as I mentioned earlier, they pump out a lot, like high volumes of trades, and they're making lots of money on it, simply because they have the resources that other market participants don't. And involving this particular case is, there's a couple different types of spoofing. In this particular case, they talk about a three-step spoofing process, three-step spoofing process that I discussed a little bit earlier. So the first step is they build up. Spoofer enters orders to stack the stock market. It could be buying or selling. And in the particular case of Chicago, the Chicago federal court case it was to sell. And then they start building this trend, and people start reacting to it, the slower market participants. And then what happens next? They pull the rug out. They cancel. The spoofer removes everything and removes all their demand from the order book. And then, as you can see here, yeah, they remove their demand. And lastly, they sweep. They sweep the market with a huge buy order, and they turn a massive profit off of this. And one other note about spoofing, I'd like to, due to the nature of spoofing, the fact that they profit off of sheer volume and not margins, there's thousands and thousands of individual trades that make up their massive profit. So, as you can imagine, would be the burden of guilt, the burden of proof on the prosecutor is tough, because if you're just going to go and drag 1,000 individual trades in front of a jury, you're naturally going to bore them. So I just wanted to note that it's particularly difficult to prove that someone not only spoofed because market participants cancel their orders all the time, but also because of the sheer amount of trades makes it more difficult to prosecute this. And briefly, for my last part, I'd just like to touch on another aspect of another form of market manipulation, very similar to spoofing, and I think it just illustrates the overall principle that we're trying to get at here with market manipulation, which is quote stuffing. So, HFT trader uses its resources, namely its speed, to buy or sell, put a huge amount of orders in the market, affecting the market, and then eventually benefiting off of their influence and their resources in the end. So what have I brought you here? I talked a little bit about market manipulation in the HFT age and how it's increasingly prevalent. And I've talked about two different forms of market manipulation and a real-life Chicago court case. Now I'm going to give it back to Risky to discuss the implications of news and on the market.
Thank you, Lou. A lot of concept, a lot of details. We discussed a lot about problems, but I'm so sorry that I have to make it worse because due to the behavior of stock markets are really correlated with the current news, right? So if so stock markets trading are highly correlated with the news. Everything that happened in the news can make stock market fluctuated a lot. For example, like what happened in Greece, the political stability not so good, and then because of that, this happened. This is, if I'm not mistaken, I cannot forget. This is Dow Jones during the financial crisis in Greece. If you see this graph, it looks so weird because it goes down slowly and suddenly it dropped really low and bounced back to the normal. And this is called the flash crash. An expert says HFT contributed a lot in this stock market mass. And Prince Wang will tell you in depth more about flash crash in real life example. Please.
Okay, so welcome to this section of Story Time with Prince. Excited? So today I'm going to talk about flash crash. All right, this happened in 2010. So before I talk about this, I just want to remind you guys. Do you guys remember last time in the current event, I said, as econ student, we need to do is connect the dots, right? Because that's what we do. And if you try to stay 15 or more encourage her and then switch to Guide. You have no idea how many times I watched that. So before I talk about this, since we're connecting dots, I'm just first Risky found a really interesting video. It'll give you a general idea of how panicked the people were at that time, and shit is real.
Everyone else is watching, and they're seeing these big negative numbers, and their confidence gets affected.
They are ping-ponging back off each other.
People are seeing this, and those memories of fear are coming back.
Procter & Gamble. Procter's trading at 60. I asked them what the heck is going on down here. I don't know.
All of a sudden here, we started hearing screaming, buy, buy, buy.
Right now, we're sitting down 875 points.
We've now broken Dow 10,000.
The Dow Jones Industrial Average dropped more than 900 points.
The market didn't work. It broke down. The machines broke down.
Fear came back into the market in a very big way.
So let me give you a background of what's going on at that time, all right? So at that time, before the flash crash happened, the news came out, as Risky said, the stock price is related to the news, according to the efficient market theory. That happened immediately when the news came out. The Greece interest rate went up to almost 30%. And that means what? The government securities are risky, and their prices are low because people are losing their faith in the government. And as you can see on the right-hand side, people were protesting to fight against the austerity policy at the time. So, question for you guys: if you're an investor in the U.S., what would you do? Because of all these uncertainties out there, we got to connect dots. What would you do? News happening in Greece. Are you gonna sell it or are you gonna buy more stocks? Pumped up. I drank too much coffee. Anyway, there's a really nice example, Procter & Gamble. their stock price dropped 20% in a few minutes. Isn't that crazy? A lot of people hold this stock to fund their retirement, and when the stock price went down, what would they do? They gotta sell it quick to cut their losses, right? And that's the part where the HFT jumped in. So before I go into the HFT part, I want to show you the quote that Jim Cramer said at that time. He said, "Well, that's true. The true means the stock price on the screen. That's true. It's 47. However, he said it can't be there. What did he mean by it can't be there? So let's go through this. So first, the European crisis happened, right? People are panicking. You know, they want to sell stocks. And when people sell stock, what's going to happen to the stock price? It's going to go down because people kept submitting a lower stock price. You know, they asked for less, and the stock price is going to go down. And the HFT part came in is the HFT people, as Karina mentioned, they react before the retail investor did. When they saw these huge chunk of orders came in, and what they did is they sold before the retail investors did. That dragged the stock price down continuously and drastically. As you can see, Risky showed the Dow Jones Industrial Average. Dow dropped 1,000 points. And Jim Cramer said it can't be there. Why he say that? Because you know, P&G is a solid company. They had a really nice quarter before the flash crash. There's no reason for P&G drop 20% on that in that few minutes, right? And a lot of people realize that. They think, wow, it's time for me to be bullish, right? They start to buy in, you know, because it's a really nice discount. And the same black happened again. HFT people, they saw this coming. They bought the stocks before the retail investor did, and dragged the price back up, back to normal. And I think there was one firm, allegedly, they benefit $20 million on that one single trade in just a few minutes. Isn't that crazy? So what's the solution over here? Do you guys see that handsome Asian male over there? His name is Brad Katsuyama. He is one of the main characters in Michael Lewis' book called Flash Boys, and I highly recommend you guys read that one. It's about HFT, and it's really interesting. He offered a solution. As Karina mentioned earlier, the reason that HFT firms, they benefit is because they have faster speed to stock exchanges. They can get their shares before the retail investor did. As you can see in the top graph, the retail investor has to go all the way to there. However, the HFT people, they can just halfway take the half of the time that retail investors need. So Brad Katsuyama, he offered a solution which is slow down both ends to make sure that the order that's submitted by the investors can be reached to the different stock exchanges at the same time to make sure that the HFT firms do not have the advantage anymore. So, are there any questions?
Is there any questions? Yes?
Yep.
How does net neutrality play into high frequency trading?
Net neutrality? I mean, net neutrality, isn't it about the internet speed?
Yeah, but retail investors access their investments or engage in investing through the internet.
Yeah, right. That's why they have a slower speed. And these HFT firms, they spend millions of dollars to lay down fibers, to make sure that they have a straight line to the stock exchanges, to make sure the speed, the time to the different stock exchanges that's shortest.
Yeah, but recently, the FCC has ruled on net neutrality, saying that all speeds of internet, even though you're an institutional investor or you're a retail investor or you're just a regular Joe on the side of the street, you should get the same speed of internet. So my question is...
well, actually you're putting new information. We're talking about the basic, concept of high frequency trading. So, yeah.
But I'm glad to hear that, though,
yeah.
because it's a huge ethical concern. Because, like, equality.
Because these people, they build the private lands to stock exchanges, and those are not public companies. Those are heavily guarded places.
So, in these buildings, what they're trying to do is these large institutions, they have the money to invest and buy the physical locations that are in those buildings, so they are physically closer to them. And if they're not in the trading buildings, they actually have a map. So Ronan Bryan, who's also a guy in the Flash Wars book, he figured it out, and they have a map with all these wires running through different cities. So they try to like avoid places. It's not just internet speed; it's also the physical location distance between them.
Yeah, and if you ask those workers who build the network, lay down the fibers, they cannot tell you like what's going on. Those information should not be released. Yeah, they're classified. So yeah, that's why they are all secretive about it.
Yeah, I was just gonna say, like, it's not about the internet speed per se. It's like they pay to be 6 inches closer.
Yeah, right. That's true. That's
is there any question again? Yes?
Are there any ways in which you think high frequency trading might actually help the market in certain areas?
Well, please.
I was talking about that earlier. First of all, high frequency trading is significantly much more profitable than traditional trading, and another way it benefits the market. Well, there was actually 4 in the article I read, but 2 of them I didn't quite understand. First, one of them they said it makes the market more efficient, and I wasn't too sure about that. But another one they said the sheer volume of trades with HFTs actually adds liquidity in the market.
But still, some experts say high frequency trading is trading in the pretty liquid stock market. So why would we need HFT then? So it's still arguable. If you Google it, it's awesome because a lot of experts have different opinions about this.
Yeah, I think I'll pick on Will a little bit right now. So I'll just actually, I'm not so much doing that as presenting the other side of the argument as well. And it's kind of tied into the idea that the expense of pursuing high-frequency trading is going to be very steep for a lot of individual investors. What you might see in turn is an arms race among somebody who's really wealthy, let's say a very well-to-do hedge fund that might be able to afford this. And that could potentially cause, as high-frequency trading becomes even more advanced, even steeper drops and subsequent rises in the prices of assets. So I guess that's kind of the real big concern going forward with HFTs.
Yeah, that article did touch on that as well, that it undercuts small-time investors.
Is there any question? Yes?
You can Google BATS, B-A-T-S. It's one of the high-frequency trading stock exchanges. What they did is just front run like Karina to get the orders before she did, because I think you asked before like why there are like 5,000 shares, because shares are not just in one exchanges. Just in one exchange, it's spread out in different exchanges. What they need to do is just send signals to different exchanges to get the shares. And however, the time to different exchanges is different. That's why Brackets VM offered a solution to slow down both ends to make sure that we get to the exchanges at the same time.
HFT creates an imperfect market, right? What's the government doing about it? What's the follow-up to this in terms of regulations?
This is totally legal. And I read a report, SEC, they had a report, they were talking about the HFT, but they didn't say, this is illegal, it's still illegal. Yeah. However, some European countries are trying to restrict the high-frequency trading. However, the flash crash still happen. So
yeah, like Will mentioned before, it's so hard to even like spoofing. It's so hard to catch a spoof, because it's super fast, and every government has to have at least computer that can, reach out the HFT's computer, which is super fast.
One other interesting point on that, is spoofing is illegal, because you said what are the governments doing about it? Well, they outlaw spoofing, which is actually bad for HFTs, because these spoofers, like these HFTs pick up on the spoofing trends, and then they act on that, and then the cancellation messes the HFTs up.
Yeah.
Kind of slows down.
Yeah, it's kind of hard to,
Yeah, and one little thing, the news just came out this afternoon. One of the spoofers got sentenced this afternoon. So yeah, government are doing good.
I think we're running out of time, but before we finish, I would conclude with saying thank you to all of you, because even if we are the business education, we learn more from you because we have to do research, we have to rehearse. So thank you so much, and please applause for all of you.